everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the inventory numbers and also, of course, Inflation Week. We have so much to dive into. Logan, welcome back to the podcast.
It is wonderful to be here. By the way, how about Brock Purdy and the 49ers? I don't want any more hating on Brock Purdy because he didn't have Debo or Ayuk or Kittle and pulls off a victory in Seattle. To all our Seattle Seahawks fans, tough.
I can't believe the 49ers won. Really, that was a crazy game. I cannot believe it. So congratulations. We are doing our in-office fantasy football, so we're competitors, but I give that one to you because that was great.
Yes, it was.
Okay, well, let's talk about our tracker and what you've seen. Of course, we had such a big week last week with the Fed, and we're going to get into inflation. But first, let's look at the housing data on inventory specifically. What did the tracker show this week?
So I got a lot of questions on the tracker this weekend, and if it wasn't for a holiday week, before, we saw a noticeable decline in inventory and a noticeable decline in our price cut percentages. So that is material in the sense that, we kind of highlighted, the market is stabilizing in mid-June. And then July came and August came. Well, August, for the first time in many years, inventory actually declined. Okay. And now mortgage rates are closer to 6%. So here it is in our tracker article, we saw a noticeable decline in inventory and a noticeable decline in the price cut percentages. But I would say, because it's a holiday, I always, no matter what, wait 2 weeks and inventory should pick up next week. But if it doesn't, we might have seen the peak in inventory. And if inventory declined in August, which does not happen for us lately, the last few years, it's usually October and November, this would be a little bit change from the previous time. And one of the more compelling things is that, I was so happy to see year over year growth of inventory at 33% because I know how hard it is to get inventory to get back up here. That number is now down to 20%. And because inventory was growing, October, a little bit later in the year, if it is the decline, we might see a noticeable decline even from the 20% level to even get down to single digits if lower mortgage rates do their thing and we see an earlier decline. So we have to put it in context that we just, in the past few years, we haven't seen inventory peak and decline in August, and we'll keep an eye on that. But we're near 6% now, and traditionally what's happened after 2022 is when rates start to get closer to 6%, the data starts to pick up, the supply and demand equilibrium change. It kind of changed mid-June with rates closer to 7%, but it makes the tracker a little bit more valuable because you don't want to wait 3 months to see kind of what's going on, and we'll take it from there. But it definitely caught my eye. But I'm going to be a little bit mindful of let's wait until next week. I even wrote in the article, hey, I think, inventory should rebound next week. But if it doesn't, then we show the respect to the data that it deserves.
I love that. I think the thing that I really appreciate about the tracker is that you have all of the data points in there that can help paint the picture. So you have mortgage rates and 10-year yield, you have purchase apps, you have inventory, and your job is to put that all together and say, here's what you should take out of this. Here's what's happening in the housing market with all of these different variables.
And the best example I try to give is late 2022, when everybody was convinced the big housing crash is coming. It might be 10 to 15 years before home prices ever see an all-time high again. There was all these things. And literally from what date, Sarah? November 9th? Yep. The forward-looking data got better, and we thought, okay, it's going to be like maybe 6 months before people figure it out, so we have to do videos and teach people, hey, listen, the housing market's changing. If home sales get down to 4 million, the supply and demand equilibrium is really going to shift. Well, home sales got down to 4 million even faster than I thought, and the supply and demand equilibrium shifted. It shifted not in the greatest way because home prices were still up almost 6% in 2023, but these things, we have not only overall history for it, but recent history as well in this crazy market. So we're going to keep an eye on this and keep everyone up to date on the data, so you don't have to wait 2, 3, 4 more months from the existing home sales report to kind of show it. And highlighting the case that, the last existing home sales report, we saw some year-over-year growth, something we've talked about in our tracker. Very, very little, but our weekly pending sales data had been picking up on a year-over-year basis. And now it gets a little bit more interesting now that rates are down here.
Super interesting. Yes, rates hit an all new yearly low again today. That happened, I think, 3 times last week. I mean, it's not dropping by like double digits, right? I mean, we're not talking like basis points. I mean, so, but hey, we will take it. So do you expect to see like, okay, now that we have had a couple of weeks of these new yearly lows, do you think that's going to show up in the purchase apps here coming up?
So purchase application data is at 31 weeks in a row of year-over-year growth, 18, 19 weeks of double-digit year-over-year growth. But what I want to see is the weekly data firm up, because in the past few
Okay.
years, the week-to-week data really starts to become positive. That was something that did not happen so much this year. The year-over-year growth was there, and we can make sense of that because the new listings data is pick up. So most sellers or buyers, they fill out an application. That makes sense because we got to the bottom end range of what we've seen in a normal year. But if the week-to-week data starts to improve, like the last 5 weeks was the first time we're under 6.64. We see housing data change when rates go under 6.64. This is why a lot of people asked about the inventory data. But the last 5 weeks, we had 4 positive weeks, 1 negative, double-digit year-over-year growth on inventory. If we get that strung out for 12 to 14 weeks, then that becomes like what we've seen since late 2022, a couple 100,000 more home sales, and we work off of that. But now it's a little bit different because labor over inflation. Now here we are, labor, and now we get a first test of inflation week.
Yes, we do. Let's transition into inflation week. So, labor over inflation week had a wild week last week with the 4 different reports, with the big miss on Friday. Of course, we did a special episode on Saturday. So let's talk about what you're looking for. What does the Fed prioritize in this inflation week?
So I think with CPI inflation, because over 40% of the index is rent, the Federal Reserve, to me, it's really going to start to look at, well, we have the service disinflation, and then we're worried about tariffs. Okay, so we're going to look at goods inflation, but if service inflation is not declining or slowing down as much as we'd like, they might make a fuss about that, medical service inflation, or rents are not coming down enough, something to that nature. I think for this week, because obviously the bond market cares about the labor market more than the growth rate of inflation. But I think that'll be the key this week, to see if we still see the service disinflation. That was the story that the Fed thought, okay, we're heading towards 2%, but now is that not going down as much? And we understand the tariff inflation. They think it's one time only, and then they'll move off with that. So that'll be, I think, the theme of this week with the CPI data, and then of course then there's the PPI inflation. But again, we're sitting here. The 10-year yield has got as low as 4.04%. We're still not under 4%, which were common 2023, 2024. Jobs data was much higher back then. The job growth, now it's not. So you could still see that there's still a modestly restrictive tone to where the bond market is. Unlike last year, where the 10-year yield got all the way down to 363, broke the Hodor line. So we'll keep an eye on how the bond market reacts to the inflation data.
Interesting thing when you talk about rent, and then the fact that they're that takes up so much of the inflation data in that report, because rent is so, that goes to like how many apartments were built, did those things stall. You're always looking at the construction workers, like how many of those are employed on things that are residential homes, either single family or multifamily. So when you look at all that, do you have an expectation of what this is going to look like?
I would say this: housing starts and permits have been at recession levels for some time. If the Federal Reserve is fearing that rents are going to pick up again, then the case is that they have stayed so restrictive that it's impacted the future supply of production.
Okay.
And the best way to deal with inflation is always supply, right? Demand destruction can be a very short-term fix, but supply is the real thing that does it. So if this is the case where they're not satisfied with the rent inflation, it's time for the man to look in the mirror, and say, maybe we've waited a little bit too long here and we need construction to start picking up again. And I think that'll be something that, down the line, maybe the Federal Reserve members start to talk about that. So we'll see how the service inflation looks for the CPI data this week.
So we knew that the bond market would be reactive last week to all that labor data. Is the bond market going to be as reactive this week when it comes to the inflation data?
So regarding this week with inflation, if some people would make the case that some of the CPI components that were hot last week or last month are not going to be as hot. And if that's the case, maybe, inflation comes in lower. That's maybe a better case for a 50 basis Fed funds cut in the next meeting. I don't know so much about that, but I think it becomes a little bit more interesting now with the inflation data and the bond market because job growth is so low. And if jobless claims were rising, I think it's a whole different ballgame. I think the bond market wouldn't care because they would see that, we're starting to lay off people and that it gets more problematic for inflation to stay elevated if jobs are being lost. But I really want to see how the bond market reacts to a softer data or hotter data now, because the 10-year yield is much lower now, right? We only got 24 basis points away from my bottom end forecast, which is the Hodor line again, right? I always have this joke that whenever the 10-year yield goes below 4%, I bring this picture out and go, we all survived the 4% 10-year, because all these grown-ass men start freaking out when the 10-year yield got at 4%. They're like, we're doomed, we're going to crash. Oh. In any case, it's going to take weaker data and a dovish Fed to get us lower and break that. But now we don't have that much leeway room as we did up when we're at 470 or 450 or 435. So fascinating to see how the bond market reacts to the inflation data at this stage.
So I feel like even since Friday when we did our podcast, Friday afternoon, because one of the questions I always ask you is like, do you think a rate cut is priced in? Do you think the Fed's going to cut rates? And then we heard talk of people saying, oh, with this jobs report, 50 basis points. But that's not what they said on Friday afternoon. What do you think?
Austin Goolsbee, one of the Fed presidents, like, I'm not sure about my rate cut. I don't know. What do we talk about? That they're going to be Fed presidents that are going to come out and go, the unemployment rate is low. Jobless claims are low. Population growth. Austin Goolsbee, Chicago Fed president, said, I don't know about rate cuts. Okay, now I think he's full of it 100% because I know Austin. And I think he's in the 100% rate cut camp. But you see the language they're using, right? So we need to be a little bit more mindful of what people like Beth Hammack and other people say. But to me, the market is pricing in a lot now. Even a 50 basis cut, it gets harder. When we get down to 380, it's like, there's a reason why I really don't forecast below 5.75%. Look what's happened, right? Fed funds rate going all the way to 2026 and 2027, neutral policy 3%. That's kind of already in the marketplace. It depends on the speed of how we get there. So the Fed hasn't turned dovish. They haven't said a discussion of accommodative stance. All they've said is neutral policy. It's going to take a while to get to neutral policy. Do they say we might want to get to neutral policy a little bit faster? That would be a change. But all this is really, the Fed funds rate is still priced in at neutral policy at 3%. So it's difficult to take that next level to get below 5.75 unless the spreads get better, the economic data gets weaker, or the Fed gets more dovish. So a lot has been priced in already, just like last year. Last year was, my God, so many things. We priced in such a recession last year that you had vertical up move in rates. Different story now. We already have 1% rate cuts in the system. We already have the jobs data skinny. So we're not even below 4%. Much different backdrop than 2024.
Again, we might have that situation where, the bond market's already priced in these things. The Fed cuts rates, and then we see mortgage rates go up,
Well,
just like we did last year.
last year the economic data got better. So if the economic data gets better, it's not going to have the violent move like we did last year. Last year, the 10-year yield
Okay.
was at 3.63%. We were 40 over 45 basis points lower last year than we are right now currently. So a much different backdrop. But again, labor data runs all, either positive or negative. If the jobs data starts to pick up, then the case against rate cuts starts to go away. And that's the paper, rock, scissors, labor over inflation. But we always keep an eye on the inflation reports to see, especially, how categorizes service inflation, goods inflation. Do we just discount the tariffs for 1 year and then move on with it? But what about service inflation now? Is that, so that becomes a little bit more interesting and a little bit more nerdy on the inflation talk.
We have so many variables. And I would say to our audience, we're less than a month, right at less than a month before our mortgage banking summit here in Dallas on October 7th. Come and hear Logan. He is going to give the most up to date thing there. There'll also be a time to ask him questions. I believe it's at a cocktail party, but he's our keynote speaker for the economic side. And my gosh, anything could happen between now and then. And we will need your insight on that day.
Come to Dallas. It's going to be a lot of fun. And boy, who knows what the Fed and what's going to happen you think about what is the possibility between now and the end of the year, shadow Fed president, who's the new chairman, what's going to happen to Lisa Cook. It's like what we said, Sarah, from July 1st. The
Yep.
second half of 2025 is going to be lit. And Brock Purdy had a fourth quarter comeback in Seattle. We're loving it all time now.
Even people who aren't Niners fans are probably loving this rate drop. So, Logan, thank you so much for being on. We will talk again very soon, and it'll probably be about inflation. So, thanks for joining us.
Pleasure.